to prevent them from making similar actions in the future. So they definitely want to send a message by quadrupling the expectation that fine was going to be about 500 million euros, I believe, was the anticipation that this was going to be.
Now, Apple have said they'll appeal. I mean, this could go on for years through the courts.
Yeah, absolutely. This isn't going to be a quick decision at all. It's likely to take several years. Apple will have to pay the fine regardless, and they'll have to comply with the EU's order, which is basically to stop the actions that they're being fined for the time being, which also plays into the Digital Markets Act that's being raised in the next few days anyway. But they do have room to contest this decision.
Well, on what grounds might Apple contest it, though?
The grounds that they're arguing against with Spotify at the minute is that it's not an unfair advantage that's being posed. So apologies, I'm being pinged all over the place. They're saying, the original point was that they were saying that Spotify blew the original complaint out of proportion, that they never had to pay the 30% fee, which is also being dubbed the Apple tax, which is the subscriptions kind of add-on that Apple charges for any company or app that's charging a subscription service through the iOS platform. They're saying originally when the antitrust complaint was raised, they were saying that they've had to pay maybe 15% charges, if that. They are now saying that they've platformed Spotify to such a degree to be a leader in the music streaming industry that there's not really an unfair competition happening at all, and therefore they shouldn't have to be fined for it.
Yeah, it's an interesting point, that. I mean, I've had plenty of people saying this to me on social media this afternoon. I mean, why should Apple promote the services of a competitor?
They have a very closed ecosystem at the minute. So something that the Digital Markets Act is actually trying to tackle is the fact that if you are any other company bar Apple itself going through Apple's platform, you will have to pay additional charges in order to get your products over to consumers. They don't believe that this is something that they should have to do because they're locked into this ecosystem. So there aren't really any alternatives to getting their products over to customers on the iOS platform at all without going through Apple's very stringent processes. So they're arguing for greater flexibility without having to pay Apple these additional charges, which Apple obviously doesn't have to charge itself for things like Apple Music, which is where the argument of having an unfair competition is coming from.
Jess, you mentioned the EU's new Digital Markets Act, which, as you say, takes effect this week. I mean, ironically, I think under those new rules, Apple wouldn't have been able to do this at all in the first place.
Exactly correct. They're basically echoing the exact same changes for opening up platforms and locked ecosystems that were coming in under that act. So it's very likely that even if Apple does contest this, they're going to have to oblige with these new rules regardless. But one of the arguments that Apple is posing is basically that the EU is also trying to apply those rules before they've actually been integrated in officially. So there may be an argument in that case, but we'll have to say, again, this process can take several years, by which point the Digital Markets Act will be well and truly in effect anyway, which gets rid of the argument that they would have had.
OK, Jess, got to leave it there. Appreciate you joining me this afternoon. Thank you.
Thank you.
Some other business news stories for you now. And shares of Macy's have jumped by 16% this afternoon after the consortium bidding for the US department store chain raised their offer over the weekend. Arkhouse Management and Brigade Capital Management said they were now prepared to pay $6.6 billion for Macy's, up from the $5.8 billion they originally offered back in December. Well, Macy's, which employs more than 94,000 people in 722 stores across the United States, last month unveiled a turnaround plan involving both store closures and job cuts. The insurance giant Aviva is going to the Lloyd's of London market for the first time in more than 2 decades. Aviva, which exited Lloyd's in 2000, is paying £242 million for Probitas, owner of a platform in the reinsurance market and which has exposure to one of the most profitable Lloyd's underwriters of recent years. Well, Aviva first held talks to buy the business in 2022 and revived its interest last summer, but on both occasions a deal could not be reached. The health, environmental and safety technology company Halma is buying a Dutch healthcare company for £73 million. Rovers, which is based in Os in the southern Netherlands, designs and manufactures sample collection devices used in the prevention and diagnostics of cervical cancer. Mark Ronchetti, Halma's chief executive, said Rovers will broaden the range of markets we serve in women's health and further strengthen our healthcare sector's position in cancer diagnosis products. And the automotive engineering group Saieta has gone into administration, it said today. The company, based in Towcester in Northamptonshire, makes drivetrains and other components for electric vehicles and was once valued on the stock market at more than £100 million. But it put itself up for sale 2 weeks ago after warning it would not be able to continue trading in the absence of fresh funding. Now, the Chancellor's hinted there will be tax cuts in his budget on Wednesday. When asked earlier today if the UK could afford them, he said any cuts would be made in a responsible way. Well, I've been talking to one of the city's leading bankers, David Livingstone, Chief Client Officer at the Wall Street banking giant Citi. I began by asking him what he was expecting to see on Wednesday.
What we expect the Chancellor to do this week is, of course, take account of some of the very small degrees of freedom that he has to operate fiscally. If you look at the 5-year forecast, he's got about £18 billion of fiscal headroom. That's not a great deal in a budget which is over £1.2 trillion spent every year by the government. So he'll use some of that. I think he'll have some measures to increase some taxation marginally, but also to be able to release either in national insurance reduction or in some tax rate reduction. But what he really should be focusing on, of course, is the expenditure side of the budget. The very significant. I mean, now the government expenditure is over 45% of GDP. That's very, very high relative to historic numbers, and that's really where the game is, and how to control expenditure, and particularly to do that because growth is not a given, and growth forecasts are probably on the weak side.
Obviously, his predecessor had an unfortunate experience with the markets when he played fast and loose fiscally. Do you think Jeremy Hunt has credit with the markets?
I think it's of course the bond markets, and that's the thing to which you refer. I think we need to remember that it was also the inflexibility in the LDI segment of the pensions market, which also contributed to that significant change in the gilts market that we experienced a year or so ago. I think it's a different situation now, but all indications are that the Chancellor will remain within the Office of Budget Responsibility sort of guidelines that are there. So I think that will be the main measure that will be taken into account.
Now, when we last spoke, you were announcing a major refurbishment of your European headquarters at Canary Wharf. Since then, Citi has announced a significant number of job losses. Do you remain as committed to London as you were?
You've put two things together which aren't really together, and I would say that, of course, we're committed to London. London is the most vibrant and international of capital markets, not just in this time zone, but around the world. So, yes, our headquarters that we are refurbishing, a very significant financial commitment to London, but also an employment commitment to London. You may know, since we last spoke, I think we have 3,000 people more in London than we did then. We have over 11,000 people. And so we need a physical footprint which matches that human footprint. And so, yes, we remain fully committed to London.
Now, you've also just taken on a new job. You're now Chief Client Officer of the bank. What does that entail, and why was the job created?
Well, we announced a management sort of restructure, reorganisation in September, really directed towards our structure catching up with our strategy. And we'd laid out our strategy 3 years ago. That remains unchanged. We are a very significant global player, as you know, and we confirmed the 5 business lines that we were pursuing: banking, services, markets, wealth, and our personal banking business in the US. And we elevated all those businesses to report directly to the CEO. But the other thing we did, and we knew that we needed to focus on, was to become even more client-centric as an organisation. So my role in the client organisation, which I lead, is a group of about 6,000 people with significant capabilities to bring a horizontal perspective to the delivery to our clients, to make sure that we're bringing the best of each of our businesses, but in a very coordinated way, which is beneficial to satisfy client needs. So that's the purpose.
And as part of this management reorganisation, you've just made a very, very high-profile hire indeed here in London. Yes. You've just poached Viz Raghavan from JP Morgan. What does that say about Citi's ambitions in this space?
So Viz will be coming in to lead our banking business globally. So that includes investment banking, corporate banking, commercial banking. It covers the full range of segments that we have. But what it says, Ian, I think, is that we have always positioned ourselves as being a major banking player, but we have ambitions to be stronger. It's about, banking ranges between about 7 or 10% of our overall revenue as a group, a significant component, and one where we have ambitions to be more effective and to continue to grow, but most important, make sure that we're serving our clients. But it is a very strong statement of ambition in that segment.
Now, 2023 was quite a tough year for investment banking. There was not much M&A activity. There was a dearth of IPOs. Do you detect more signs of life so far this year?
Well, as you know, the debt markets have been very, very strong this year, and I think there's been both in investment grade, but also emerging in leveraged finance, some much stronger market conditions in 24 than in 23. M&A and ECM, as you know, potentially more sensitive to the outlook for sort of economic activity and confidence. And we are seeing, certainly in equity markets in this time zone, Europe in particular at 52-week highs, I think there is more confidence that the equity markets will provide a sound footing for sellers to be able to bring IPOs or to bring accelerated offerings to market. So quite positive on the ECM. M&A, as you know, can be a little bit more fickle. We're seeing certain signs of life. There have been about 10 quarters of muted activity in M&A, and that's a long period. And with more certainty on interest rate outlook, inflation outlook, and potentially growth outlook, I think corporate leaders will be more confident, whether buying or selling, that this is a good time to act on M&A.
Are you surprised at how robust activity has been in the debt markets and how well equity markets have performed, given that interest rate expectations have really been quite significantly recalibrated since the start of the year?
Yes, but if you think about it from a funding point of view, if you're in need of liquidity, I think the spreads coming in has been the main component. As obviously absolute levels are set off the sovereign, but I think corporate treasurers or whatever, or financial institutions and funders, they need to know they've got the liquidity. So no, not surprised that they've taken advantage. The expectation, of course, is for the curve to continue to flatten, but that is something which is they need to act now to make sure that they have the liquidity they need to run their operations.
It's recently been reported that you've reduced bonuses by 20% this year. Have you had a job maintaining morale? And are those reports accurate?
I have not seen those reports, so thank you, Ian. I think we have on the back of the confirmation of our strategy, the structure that we now have, which is the other byproduct, of course, is to make us faster in decision making inside the organisation. And so we understand that any reorganisation which does unfortunately have some job losses associated with it, and some very good people unfortunately have left our organisation as a result, that does have an impact on morale. But we are committed to complete that by the end of this month, and then very much focused on the execution of the strategy from there.
That was David Livingston speaking to me from City. We've got some breaking news for you. The House of Lords has been voting on the government's Rwanda bill this afternoon on an amendment to the bill. We understand they've suffered a defeat, the government. Our chief political correspondent, John Craig, is here very shortly, as I say. Those are the scenes right now from the House of Lords.
Amendment 3, Baroness Chakrabarty. Not moved. Amendment 4, Lord Hope.
There are 4 amendments in this group, all of which are in my name, and to which the noble Lords, Lord Anderson of Ipswich and Lord Jermyn and Baroness de Souza very kindly added their names as well.
Let me tell you a bit more about what's been happening there. The Lords have just been voting on Lord Coker's Amendment 2. The amendment seeks to ensure that the eventual Act is fully compliant with the rule of law. The vote went contents 274, not contents 172. That means a reverse for the government, a government defeat. That is the first defeat that the government has so far had on the passage of the Rwanda bill through the Houses of Parliament. Obviously, it's gone through the Commons largely unscathed. So quite a big moment this for the government. Our chief political correspondent, John Craig, is now with us. John, how significant is this for the uninitiated?
What's significant is the size of the defeat, Ian, because it's a thumping defeat. Numbers were 274 to 172. And so this is the first of 5 votes we're expecting today. That was on a Labour amendment basically challenging the government's assertion in the bill that Rwanda is a safe country. And we're likely to see, well, we're going to see votes later on in the next few hours on amendments giving the courts the rights to challenge that claim that Rwanda is a safe country. Now, what's going to happen is there are votes today, more votes on Wednesday, further votes next week, but the assumption is that at some point the Labour Party will say, OK, you can have this bill. They're not going to block it altogether in the long term. So we are expecting the bill to become law probably at some point in March. But for now, the government is getting a real spanking in the House of Lords. We heard a really powerful speech from Lord Clark, Kenneth Clark, a former Tory Home Secretary. We heard from the Archbishop of Canterbury, among others, talking about why Winston Churchill set up the whole International European Convention of Human Rights procedure back after the war, response to what the Nazis had done, and so on, the Archbishop was saying. So, the government will be dismayed that they only got 172 Tory peers to back this. As I say, the real significance of this is it's the size of the defeat. We're likely to see more defeats and pressure on the government to make some amendments. I'm not sure they will, though, because they are determined to get this bill onto the statute book so they can start some flights to Rwanda. They're hoping, obviously, to do that at some point, March, April, perhaps, but this is an embarrassing defeat for the government here because, as I say, the scale of the defeat, the numbers involved.
John, very briefly, I'm interested that you say you think ultimately the government will get its way because, of course, it has been making very dark threats to the House of Lords not to stand in the way of what they argue is the will of the people in this particular instance. What happens next in terms of the bill returning to the Commons at some stage?
Well, it'll go back to the Commons, and, of course, the Commons, with its majority, the government majority, will overturn the Lords' amendments, and we'll have what's known in the jargon as ping-pong, the bill going backwards and forwards. Now, there are some I was talking to a Conservative peer this afternoon who is quite critical of the Labour Party for their stance on this, because Labour eventually will let this bill go through. Basically, Labour don't want to be saddled with this problem if they were to win the general election. And so at some point, Labour are going to raise the white flag and let this Rwanda bill go through. But for the moment, the Labour Party, and it's, let's be said, quite a lot of Tory rebels, given the scale of that defeat, and indeed the bishops are inflicting some real damage on the government, and basically they're holding up the bill. These defeats will delay the passage of the bill onto the statute book, but eventually it will become law because Labour are not going to go the whole way of blocking it and holding it up. And some, as I say, some of the Tory peers I've spoken to, and indeed some of the peers from smaller parties, are quite critical of Labour for eventually throwing in the towel and saying, OK, you can have this bill. But that's not going to be for several weeks yet.
All right, John, thanks for that. European stocks have closed the afternoon in mixed territory, it's fair to say. The big faller on the, well, not really much of a faller, the DAX in Germany, more or less unchanged, to be honest. Talking points today in mainland Europe include Piraeus Bank, that's the third largest lender in Greece. The shares have risen by 3% in Athens after the sale of a 27% stake by the Greek bank bailout fund was met with strong demand. Well, here in London, the FTSE 100's finished off just over 0.5% in a broad-based sell-off. Some of the big dollar earners have been weighing on the index. In percentage terms, the leading FTSE faller today has been Ocado, off 6.5%. It was off 8% at one point amid concerns over its relationship with its joint venture partner, Marks and Spencer, which, of course, regular viewers will know from last week. It is threatening to sue over a payment. Meanwhile, St James's Place, which we talked about a great deal on Thursday when the company announced a shock £426 million provision, shares off there 4.25%. Among blue chip gainers, aircraft engineering group Melrose has risen by 2.25%. It's got results out this Thursday. Outside the FTSE, Clarkson, the shipping services group, that's finished up 3% after it reported an 8% rise in full-year pre-tax profits, while the Engineer Senior has finished up 1.25% on its results. To the downside, Hypnosis Songs is off by 9% on news that dividend payments have been suspended for the foreseeable future. Over on Wall Street, all of the main stock indices have opened to the downside this afternoon. Apple is off some 2.75% nearly now on its €1.8 billion fine from the EU. Ford, meanwhile, is up some 3% just now. That's on a sales update. Over on the foreign exchange markets, good day for the pound. That explains why some of the dollar earners are off in the FTSE this afternoon. Sterling finishing up currently nearly 2/5 higher against the greenback, up 1/4% against the euro. Single currency, meanwhile, up 1/5 against the dollar. As for the oil price, well, that hit its highest level for a month on Friday night ahead of an expected decision by the OPEC Plus cartel at the weekend to extend production cuts. That was duly delivered, and a barrel of Brent crude currently changing hands at $83.14 a barrel, off just shy of 0.5%. So joining me this afternoon is Joshua Mahoney, Chief Market Analyst at Scope Markets. Josh, good to see you today. Why do you think the FTSE 100 and the 350, for that matter, have underperformed mainland Europe this afternoon?
Yeah, well, I mean, there's going to be a couple of factors that lead into it. First and foremost, of course, the big dominant factor for this week is going to be the spring budget. And certainly we had come into it not so long ago, really expecting to see quite substantial tax cuts from the Chancellor. That isn't necessarily the case anymore. Certainly, we're still seeing them allude to the potential for some tax cuts. But that wiggle room, that headroom, appears to have faded over recent weeks. And that's a question mark of whether they're willing to essentially bring a sort of more greater instability in terms of the fiscal picture to essentially enhance their outlook for the election. We've also, as you alluded to, seen some weakness of the fact that we're seeing strength for the pound, weakness for some of these other currencies against it, and therefore those companies that are earning abroad essentially see devaluation of their earnings.
Absolutely. What do you put the strength in the pound down to today?
Well, part of it is coming down to a weakness for the US dollar, because we're also seeing strength in terms of the euro. Really, this is starting to see the beginning of a process where we've essentially seen a realignment in terms of expectations from the Federal Reserve. Not so long ago, people were expecting 7 rate cuts this year. We're now expecting 3. And that period of time has led to strength to the US dollar. But now we're seeing an alignment between market expectations and the Federal Reserve's expectations. Now we're likely to come into a position where that dollar strength starts to come off to the benefit of the likes of the pound, the likes of the euros we're seeing today.
What about the oil price, Josh? I mean, what OPEC Plus announced over the weekend was largely expected. Is that why the price is down? It had risen in advance of this announcement?
To an extent. I mean, it's also a question mark of whether the people think that this makes a difference, because ultimately they're just remaining as is. We're seeing an extension by 3 months until the middle of the year in terms of those output cuts. But the US continues to ramp up production, with record high production over in the US. They're just gobbling up that market share from OPEC. And so it's just a question mark of whether people think that the demand picture is going to change anytime soon. Demand still looks relatively weak. And despite the fact that they're maintaining these cuts, we're not necessarily seeing anything added on top of it. US production continues to increase.
Briefly, Josh, Bitcoin continues to charge ahead. How much further do you think this rally's got to run?
Well, listen, we've come into this year where we see the so-called halving event, where every time it happens, it's once every 4 years, people think that it's the beginning of this massive bull run, and historically it has been the case. Of course, we've seen these Bitcoin ETFs come into fruition this year, and so there's a possibility of greater inflows in terms of that direction. But certainly, usually we don't really get started until after the halving event. That is in a month's time. So the fact that we're now just 3% down from the record high does point towards the possibility of a very eventful year ahead for cryptocurrencies and Bitcoin in particular.
OK, Josh, got to leave it there. Thanks for joining us today. Good to see you. That's it from me. I'm back tomorrow morning at 11:30 with our next edition. Hope you can join me for that. In the meantime, do stay tuned. Coming up after this short break, it's Mark Austin with the News Hour. Thanks for joining me today. Cheerio.